Hi, my name is Spencer Carenti. I run Alkaline Advisors, and today we're going to be reviewing our premium asset management template. So this should take 10 to 15 minutes, and to start, I'll go over the reason why one would use a template like this, and then we'll dive into the tabs in the model, and then finally we'll go into the calculations in a little more detail. So the reason why someone would use a template like this template allows us to track the actual figures that are occurring at a project level as it relates to revenues, expenses, costs. It then allows us to take those figures and trend them to where we anticipate our property will be at stabilization. And then once we're at stabilization, the model allows us to take those figures and reforecast them throughout the duration of the hold period at a property level. So this will allow us to provide a little more detail and a little more accuracy as it relates to capital we might have to come out of pocket during the hold, or ultimately our return metrics at the end of the day. So to start, this model is what we call fully dynamic, meaning that you plug information into blue cells and then all the other info auto-populates. So you'll see we have blue tabs. When we click a blue tab, you'll see we have blue cells. Once you update information into these blue cells, let's say, for instance, we make sale value 4 cap instead of a 6, everything updates automatically. This model only has 3 input tabs, and most of the inputs are housed on the Inputs tab. Then we have the Partnership Returns tab. This is where we segment out the GP and the LP equity structure and what the distributions look like thereafter. Then we have the Actuals tab. This is where we're documenting what actually happened at the project level as it relates to rent, loss to lease, vacancy. You could be as detailed or non-detailed here as you'd like. And then finally, everything else in this model auto-populates. So we have the Summary tab, which gives us an understanding of overview at a project level, operations, return profiles, debt, equity infusions, and then NOI and or debt service or just free cash flow. We have a Disclaimer tab. We have a cover page. We've kind of briefly gone over these inputs tabs. We have a total consolidated cash flow line item as it relates to a monthly level. We have an annual cash flow roll-up. Then we have these 4 yellow tabs. So these yellow tabs give you an understanding of the cash flows on a monthly basis as what actually happened. So this is going to be almost identical to this Actuals tab. Then we have a Cash Flow Overrides tab, and I'll explain what this is when we dive a little further into the Inputs tab. Next, we have the Cash Flow Pre-Stabilized. So essentially what this tab allows us to do is to calculate the numbers from the actual figures to date through the point of stabilization. And then what this Projections tab allows us to do is to calculate the figures once we hit stabilization throughout the remaining life of the hold. And we're taking all 4 of these tabs, layering them on top of one another, and that's where we get this total cash flow tab over here in green. So with that, let's hop back to the Inputs tab. And what I'm going to do is I'm going to go through the inputs as they relate to general info, exit assumptions, timing assumptions, operating assumptions, and then the overrides. We have operational overrides as it relates to operations, and then we have additional CapEx and renovation. We have an existing debt and refinance, and then SOFR curve. So to reiterate, there are 3 main components to this model. The first is tracking the actual figures as we have them to date at a property level. The second is anticipating what our stabilized figures will look like. And then the third is taking those stabilized figures and then trending them into the future. So for phase 1, tracking the actuals, that's straightforward. You'll see we're able to say we have actuals through a certain period of time. In this case, we'll say we have actuals through month 11. So if we go to Actuals tab, you'll see we're only able to fill things out through month 11. So what happens, and I've already populated this through month 14, but what happens if we say we have actuals through August 15th of 2024? Well, let's say 8/15/24. Now we have actuals through month 14. If we go back to the actuals tab, you'll see month 12, 13, and 14 are now populated. If we say we have actuals through month 15, we can go back to the inputs tab and say we have actuals through month, let's say September of 24, and we go back to the actuals tab. Well, now we're able to populate what happened in August. But in this scenario, we're going to say we only have information through the end of July, so we're going to run with that. The model calculates at the end of each monthly period. So if we're not at the end of a month, so in this case, we're in the middle of August, we're not going to be able to calculate the actuals for the month of August yet until we're past August. So once we have the actuals keyed in, and in this case, again, we're through July, we're then able to say, well, based on those actuals, how are we trending those figures through to stabilization? We're now saying we anticipate stabilization occurring in month 18. If we want, we can say we anticipate stabilization occurring in month 20, or whenever we think it'll be X many months after the acquisition date. And it'll show you not just the month as in month 20, but the actual date as well. And then we have the figures we anticipate achieving at stabilization. And this is all on an annual basis. So what we're doing from month X at the last date of actuals, so month 14 in this scenario, through month 20, is we're trending the actuals to stabilization. And we're doing that calculation-wise on this cash flow pre-stabilized snapshot. So in essence, to be as accurate as possible, we're saying the market rent at stabilization is going to be $340,000. Currently, in month 14, it's at $28,200. And then we're choosing what figure or figures do we want to average to then straight line the annualized amount through to the stabilization period. So we can toggle between taking just the rolling trailing one and then straight lining that. So if we took the rolling trailing one and straight line that, we would take the actuals, we would take 28,200. We would say, okay, based off of that figure of 28,200 pre-stabilized. So this would be 28,200 over here. If we took what we anticipated in month 20 at stabilization minus 28,200, that's going to be a $133 difference. And there's 6 months in between where we are today and stabilization. If we straight lined the difference between today and month 14 and stabilization, you will see it is at $22 difference every month. So what we're doing there is we're saying, based on the fact that we're just taking the rolling 12, annualizing it, and going to the next month over, we're just trending where we are today through stabilization. We can also say, well, what if we took the trailing 3 months of information we have, or the trailing 12 months of information we have? Well, for that first period in month 15 that we're estimating, we're taking these 12 figures, adding them together to get a figure of $280,100. And then we're taking the difference between that $340,000 and that $280,100 that we just calculated. And we are then dividing that over 6, because there are 6 periods until we hit stabilization. We are adding that difference to that next period, right, in month 15 to get to that $24,174. So then in order for us to calculate what this month 16 would be, we're taking the most recently calculated figure at month 15 plus last 11 months of actuals that we have, adding all those together, and then taking the difference or subtracting the difference for that 340,000. Again, it's this figure annualized, 340,000, to figure out what the total difference is divided by 5, because now there are 5 figures outstanding that we need to solve for. So essentially, we are just taking the trailing 12 months NOI as we've calculated to get us to stabilization. And then that's how we're figuring out what the pre-stabilized figures are through stabilization. And we can do that on an individual line item basis if we want to say, okay, well, utility reimbursements only going to be trailing 1 versus trailing 12 versus market rent, which will be trailing 12. So all that will be trended based off of whatever we choose here. And it'll be trended based off of the actuals we currently have through the projections at stabilization. Now, what if we're already stabilized, right? So what if we anticipate stabilization to have occurred in month 13? If that's the case, you'll notice all of this is grayed out, because what we're doing is we are just escalating the figures thereafter, the actuals that we have, right? So in this case, we're escalating, we have actuals through month 14. So then we're escalating the actuals from month 15 to 26, which is that next year. And then the year after, 27 through 38, and the year after, 39 through 50. So again, if we were to make the stabilization month 18, that stabilized year in month 18 through 29, which we've just outlined over here. And then that year after stabilization, month 30 through 41, we're then growing whatever we anticipate stabilization to be. We're growing it thereafter by either taking the trailing 12 or the trailing 3 or the trailing 1. And then outside of the market rent line, we're adding additional functionality, which is this percent of market rent. So for instance, if we say vacancy loss is going to be a percent of market rent, we could say it's going to be a negative percent, right? It'll be, let's say, negative 5% of the market rent in this period. And if we say it's not going to be a percentage of market rent, if we say we're going to trend the T12 of stabilization growing at 2% annually, this percentage will be growing whatever that T12 is versus a percentage of that T12. I'm happy to dive a little deeper or answer questions if you haven't. But essentially, again, if you were to just zoom out, the way you think about this model is we're tracking the actuals up to the point we have them. If stabilization has not yet occurred, we're then trending the actuals that we have through the point of stabilization by straight lining those figures. And then once we are at stabilization, we're trending those stabilized figures throughout the duration of the hold period. And that's what we do over here. So we've already discussed actuals, right? We load in the actuals, and that is how we calculate this actual tab. We've discussed the cash flow pre-stabilized, which is once we have the actuals, how are we straight lining the trended figures, again, that we have on an actual basis, taking just T1 or T3 or T12, and then growing them through the point of stabilization. If we're already past stabilization, this cash flow pre-stabilization tab is irrelevant, because if we go and make stabilization month 13, we can go to cash flow pre-stabilization. This will be blank because we have all the actuals that were up through stabilization, and then we're trending the actuals through the point of disposition throughout the hold period. But we'll go back for a second. And now we have stabilization month 18. And then we have the projections. So the projections will come online once we hit month X of stabilization, in this case, month 18 of stabilization. Then the projections come online thereafter, and they're growing based off of those stabilized figures. What we haven't yet talked about is the cash flow overrides tab. The cash flow overrides tab is saying, well, in a month's period, if, for instance, we know there's going to be additional costs that aren't going to trend neatly in line with a growth percentage of X per year, what we could do is go back to the inputs tab and say, well, we want marketing, for instance, we know marketing is going to be $20,000 starting in month 15 because we're running a specific campaign. and it's going to be a 2-month campaign. So essentially, we know that we're going to be charged an additional $20,000 a month starting in month 15 for 2 months. And this is going to override whatever we anticipate the pre-stabilized cash flow line items to be. So if we were to go to the override and go to monthly marketing, you'll see we have these $20,000 figures coming online in month 15 and 16. And then if we go to the cash flow tab and we go to marketing, in month 15 and 16, you'll see these $20,000 figures. But essentially, that is a way that we would calculate the override section, and that'll all flow through the cash flow tab. So if we go back to inputs, we have overrides, operational overrides over here. We have additional CapEx and renovation, which we can add in. That's not at an operating segment. It's below, right? It'll be shown in CapEx. So all of that will flow through to the CapEx segment. And then all of that will then, again, flow through to this cash flow tab. And then underneath that, we have the financing assumptions. And on the financing segment, we have existing debt. If there is existing debt, you'd load it in. We have refinance opportunities. We have existing preferred. And then we have second refinance if there is. And you can toggle all of these on or off. We've got minimum debt service coverage ratios. We have maximum LTVs. We have minimum debt yields. And all this will size the loan accordingly. And all of this flows in automatically and then helps you understand what your projected unlevered and levered returns are and your projected GP and LP returns are. Again, the GP and LP is based off of the partnership return split where you can toggle between the hurdles between the GP and LP. So it just allows us to get a little more granular into how we're tracking the costs, into how we're tracking the revenues and the expenses, not only what's happening currently at a project level, but then how we're taking what is happening currently, trending that to stabilization if we're not yet at stabilization. And then if we are at stabilization or if we already have figures past stabilization, we're then forecasting those into the future until inevitably we sell the asset. So that is our asset management template. I hope you enjoyed this video. Please reach out if you have additional questions. Happy to walk you through, but we do sell this template as is. We also are able to customize any asset management template for you, whether you have softwares that you're tracking your actuals on via QuickBooks or Yardi. We can build out the functionality for you to just paste that right into a model and everything auto-populate accordingly. So again, my name is Spencer Crenti. I run Alkaline Advisors, and I appreciate you spending the time to walk through this video with us. Hope to hear from you soon. Take care.